with your hosts, Aidan Campbell
and Joanna Wells.
In today's episode, we want to give an example of why cost plus pricing can really create problems. And this is relating to the world of foreign exchange or Forex. And what this it really highlights for us one of the major issues with using cost plus as your pricing methodology.
So, many of our clients and businesses that we've consulted to, especially in the B2B manufacturing and distribution space, have really led their their pricing strategy using cost plus. And at the beginning of the journey, we're very adamant that that was the best way forward, that it was clear, that it was going to be fair, and it was the best way to calculate costs. However, as we went further into the data and to see, the operations of their business, how it all worked, where they got their products, often we'd find, for instance, in a distribution business, that they would buy their products overseas, in China, for instance, maybe to try and get a lower cost, try and get a cheaper product. And then when we looked further into that, we found that the cost calculations were just an aggregate average of foreign exchange mechanisms, which can change multiple times in a day. And often they'd find, as a result of that they're either overcharging or underselling their offers.
The example I would give is just imagine you're a fancy restaurant, say in London or New York, and you're serving Argentinian steak. And Argentina is a country that's gone through a couple of, reasonably regular, massive devaluations over the years. So in theory, if you're operating a cost-plus environment, whether you're the butcher shop, a hotel, or a nice restaurant serving that Argentinian steak that's flown in that day, say you fly in that steak, and yesterday it cost $15 American, for a steak. Then the next day the exchange rate collapses, but you're still buying them at Argentinian pesos. So what do you do then? Do you reduce your prices by 50%? Of course you don't, because logically that makes no sense. And this simple fact can really be applied to pretty much any cost plus environment. Just because your prices drop, should you decrease your selling price? And the answer is clearly not. Clearly the customers who are coming into your restaurant, they are buying the steak not based on the cost plus methodology. They're not researching Argentinian or Uruguayan farm sales prices. They really are just going in for a nice evening and experience the value of what they're purchasing, which is really unrelated to the actual cost of the production or delivery of the product.
And to look at it the other way, if you're, as a business, if you're setting your prices using cost plus to understand, to target some kind of margin, but ultimately your calculations on costs based on a fluctuating and very complex exchange rate mechanism are incorrect, and pretty much you're just aggregating and sort of guessing using, rounding things up or down just to suit, it's pretty much guessing what the costs are, then really, are you going to get the margin that you're targeting, or you're really just hoping that you're going to get it? It just sort of lacks that sort of, it gives a semblance of rigor that really isn't there.
Yeah, I suppose another example I'll give is I previously worked in accounting, and we were doing due diligence on a company. It was an American toy company that was buying a British traditional toy company that really in reality was just a shell at that point. All manufacturing, all research, all development, everything was done in China. This is about 20 years ago now. And the reality of it was they were reporting better and better results. Over that last year, they had profits that were up 50%. Profits were up 50%, but in reality, when we looked through the books, what had happened was it's just the British sterling versus Chinese exchange rate had dropped or had improved from a British perspective. So they're reporting higher profits. In reality, if it had gone the other way, nothing to do whatsoever with their business practice, it would have shown a major decline in profitability. So the American company walked away from that transaction. But you really have to look into things. Why are you making decisions? Why are you selling things at a certain price? And does the cost input, you have to be aware of what it costs for you to produce it, but really should that influence the selling price? And I suppose we're going over again what cost plus pricing, the flaws with it. But we thought this was a great example of where the flaws could lie. The other thing we'll say is when you get into the realms of dynamic pricing, where pricing changes multiple times a day, there is nothing more dynamic than the Forex market. I think it's only closed for a couple of hours a day, or when there's a gap in the world between maybe Tokyo opening and wherever's the last place to close. But the reality, and over weekends, but the reality of it is for say 20 hours a day, it's been traded in huge volume globally, and so the price is changing infinite times per day. Dynamic pricing, obviously, in a cost plus model, no one's going to really implement that unless you're dealing in a Forex environment yourself, unless you're selling Forex services. But otherwise, if it's a B2B, B2C environment, it should really have very limited impact on what you sell at.
I think really, if you're trying to maximise margins simply by sort of outplaying the exchange rate, or trying to utilise, get your view on get it cheaper products via exchange rate benefits, then you have to have really good analytics. As Aidan said, that is a dynamic strategy in itself on the supply side. Often companies in B2B, are really still using Excel just referring to exchange rate now and again. They don't have a dedicated pricing function to really manage that either. It's often done ad hoc, even I would say on a yearly basis. And as I said, there's millions, the exchange rate can change millions of times. So, just make sure if you're trying to maximize margins, it's not particularly risk-free just to do it via exchange rate. You've got to be on the ball with that and think again about value. Try to, think about maximizing margins by looking at supply and demand dynamics, and that truly does require a dynamic pricing capability with a dedicated pricing team to manage it full time every day, so things are flowing and everything's recorded and the price setting process is updated.
Yeah, that's it from me on this one. Have a great day.
Yeah, thanks a lot.